Hi, this is Sonnie from Fairhaven Wealth and the New Zealand Wealth and Risk blog. Now, the purpose of this video is to go behind the curtains of a lot of retirement expenditure calculators. So there are a number of great ones online. The sorted retirement calculator is a good example. But they tend to be fairly straightforward. They'll ask you some variables and then they'll spit out a figure, and they'll almost give you a sense of certainty about what that figure will be. The purpose of this video, which I make no apologies about, it's mainly an Excel spreadsheet that I'm explaining, lifts a veil behind it and explains how those figures are calculated and how you can play around with it yourself to tailor it to get a better understanding of what this decumulation process is. A couple of things I just want to start off with. I want to just explain that decumulation refers to the process of spending or decumulating the capital that you've accumulated over the course of your working life. So we're all pretty familiar with the concept of accumulation, which is saving wealth and building it up with by continuing to contribute and generating returns. And decumulating is where you get to a stage where you're no longer generating an income, and so you're wanting to spend that in an appropriate way. A lot of people talk about wanting to live off the interest or the interest of the interest, and that's admirable if that's what you want to do and you want to leave a good estate. But the reality is a lot of people do need to decumulate, or would be able to at least live a much higher quality of life if they became comfortable with that. And that's what I'm trying to demonstrate in this video. One thing, just reviewing it, that I didn't talk much or at all about is another valuable part of this process is that it can help better inform how much you actually need in order to retire. And I think a lot of people will actually end up being a little bit surprised by the fact that you might not need to accumulate as much as you might initially think, especially if you're thinking in the context, especially that's talked a lot about in the US with the 4% rule that doesn't factor in New Zealand super. Again, there's no guarantees what New Zealand super will look like in the long run, but it is a factor. And it also doesn't necessarily factor in that decumulation process and what your expectations are in relation to longevity, freeing up capital in your home, and any other decisions or expectations in relation to your cost of living over the course of your life. I hope it's valuable. If you've got any questions or you want to provide any feedback, don't hesitate to contact me. I really hope that it's a valuable resource, and I encourage you to give it a go yourself, which is why I've kind of started it from scratch in this video. And by all means, if you want to run through the process in a tailored way, contact me through my business, Fairhaven Wealth. The purpose of this video is to actually show what decumulation looks like. So it's very easy to go onto web calculators, the sorted retirement planner being a really great example of this, where you can talk about how close you are to retirement, how long you need to plan for retirement, how much you want to spend, and where the money will come from, and it will give you very specific figures for how much you need or that you might have a shortfall for, or what have you. What I want to do is to go behind the curtains in relation to how these figures are calculated. So I'm going to do it in the form of a spreadsheet, and one advantage of doing it this way is you can get more insight into how much you might actually need and see what the implications of playing around with some of these figures might be. It also enables you to have some more flexibility for considering other additional scenarios or tweaks to what your retirement might look like. And I think the best way of doing this is to actually just demonstrate by creating a spreadsheet from scratch. So what I'm going to do is I'm just going to create a few columns. So we're going to say the age of somebody, and we're assuming that they're going to retire at the age of 65. They've got a balance of financial investments. They'll be generating a return on that balance. They will be making some contributions, and in fact how about I change that to income, so that will be New Zealand Super, basically. And then they'll be making withdrawals. So then we'll have a closing balance. And the closing balance at the end of a given year will be the opening balance, plus the returns generated, plus any other income sources, minus any withdrawals. So we get 866 there. We'll drag that down. So I'm doing this explicitly on Excel and creating it from scratch so that you can do it yourself if you're that way inclined. And I'm going to start just hypothetically with an opening balance of investment assets. So this doesn't include property or anything like this. This is the nest egg that you have to help support your lifestyle. So it also doesn't include stuff like furniture, contents, cars, or things that you're unlikely to turn into assets to support your lifestyle. So we're starting off with about opening balance of 500. Closing the opening balance of each subsequent year is the closing of the previous one. And we're also going to assume a constant after inflation tax adjusted return. Now, I really want to stress that this is an assumption. When I do this with this sort of exercise with clients, I'm always at pains to say that this isn't a forecast so much as a floorcast. The only guarantee I can give with these sorts of projections is that they will be wrong. But what they can do is they can provide you with some context or perspective within which you can make financial decisions, including how to invest or whether to spend X amount per year, or whether to right-size the house or buy another house, or help out children with purchasing homes of their own, for instance. And the reason I make the assumption of inflation-adjusted returns is so that every dollar here we can look at throughout the spreadsheet is going to refer to dollars in today's terms, or in terms of buying power. So we don't need to do any kind of internal calculations about whether a dollar today is going to be by less than a dollar in 20 years' time, or anything of that nature. It's also after tax and after inflation. So say 3% may sound very low, but it might actually look more like 5 or 6% in nominal or headline figures, after which you have to take out some portion of tax, and then after that you might have to make some adjustment for inflation. So what I can do there is the return, and I'm calculating it just annually, is the opening balance by that figure that we assumed there, and I'm just dropping it down there. In this scenario here, I'm just going to assume that we're talking about a couple. They're both turning 65 on the same day, and they'll be getting, say, about $32,000 in New Zealand superannuation each year. And again, I'm assuming that New Zealand Super, they'll continue to be eligible for it, and that the rate of New Zealand Super will stay effectively the same in inflation-adjusted terms over the course of their life. Might go up and down in any given year, but we really don't know. It's again one of the other big uncertainties about retirement that we have to just plan around. And this next column is in some ways where the rubber hits the road. It's the withdrawals, or how much we're actually spending in any given year. So like if we start at, say, $40,000 per year, and for reference, that's after tax and such, that's about $770 per week. I'll just put that up there actually. And so I just make that the same in any given year. Now, again, this is an enormous assumption, because people will spend more or less in any given year. If you own your own home, you might have issues or renovations around the home. You might have travel in certain years. You might have health issues. And certainly as people get older, they might have less energy and inclination to spend money down the track. And then there's also the talk about retirement expenditure being U-shaped. You tend to spend more at the start of your retirement. and that gradually decreases, perhaps ticking up at the end of the life cycle when we start having more medical issues and perhaps needing residential care and support of that sort of nature. It's often talked a lot about being U-shaped, especially in other countries. I would say New Zealand, it's probably not quite as exaggerated as other countries like the US, which is where you get a lot of money commentary about. But it is something to at least keep in mind. And on that particular note, this is an enormous assumption that all of these retirement calculators that just spit out a simple figure make. It's almost always that the assumption that is that expenditure will stay the same throughout the course of their life. We'll play around with that figure and we'll investigate how we can change sort of scenarios. So we're going from the age of 65 to the age of 97, and that figure there is completely arbitrary. The only reason I'm picking it there is because it fits on the screen, and I don't want to make the text any smaller, but you can make it shorter or longer than you like. In fact, I would tend to do it for a bit longer, just so you can see the impact over the long run. Another thing that I'll just do right now, just to make it a bit easier to see what the impact of some of the decisions that you'll make are, is just create a chart. And what this chart represents is the opening balance or nest egg of someone. Sorry, I just got that wrong. At the start of a given year. So if we actually run this scenario where they're generating a constant after-tax inflation adjusted or real return of 3% per year, continuing to get New Zealand super of $32,000 a year and spending $40,000 per year, not only are they able to cover their costs, but their assets are increasing over time. And this might be great. This might be exactly what you want if you want to ensure that your children or causes that you care about get a lot out of your estate when you eventually pass away. The reality for most people, however, is that they want to at least support a decent quality of life during their retirement, however they define that. And the reality is that most people will have to go through a process of decumulation or spending assets, their capital, gradually over the course of their lifetime. So what happens if we put, say, withdrawals up to $45,000 per year? And again, the outcome is actually not too bad. We can try 50,000, and what we can see here is that over time, this couple is spending money, is eating through some of their capital, but they're still going to have 342,000 or so at the age of 97, which should still support a decent quality of life. If we increase it to say $55,000, still not too bad, and my intuition is 60,000 we'll see it intersect at some point here. Now this might not be what you want, or it may be. I mean, everyone is in a different situation at the age of 65 and has different expectations about their longevity and their health, and to what extent they want to prioritise spending and enjoying life in, I guess, the immediate term or the start of their retirement versus later. Another factor which you can't include in a lot of retirement calculators is it might be that, say, at the age of 80, you might expect to downsize or right-size your home, in which case that might free up some additional capital to support your quality of life. So if I look at, say, the age of 80 here, and I mean, I'll just change this column to incoming And so what happens here is you might continue to receive New Zealand Super, but this particular year you might have a substantial cash injection of, say, 200,000, and that might be from selling the family home and buying something that is a bit smaller and cheaper and freeing up this capital. And you can see that there's a fairly big bump. And if you make this assumption here, your ability to spend over the course of your lifetime improves, and you might even be able to get away with spending an extra $5,000. Again, depending what your expectations are and what you want to factor in for you. It's also relevant if, for instance, we went back to, say, $55,000 a year. It might also be relevant for modelling what might happen if you want to help out family members for whatever reason. Say, perhaps in 5 years' time after retirement, you might expect that you'll need to spend, say, 100,000 in capital, or you might want to help a child get into the property market, and then perhaps in another 3 years' time, another child. 100,000, and you can see what the impact might be on your capital and the course of your life, and you can kind of look at all of the different variables and see how they will work together in terms of your process of decumulation. I'll just simplify everything here. Another thing that you can look at is previously, I referred to retirement being somewhat U-shaped. So certainly as people enter into their late 70s and early 80s, they do tend to spend less money during that period. And there's a fair amount of research that bears this out. So it might be that at the age of 80, you might want to model that instead of spending 55,000 or whatever you've been spending in the earlier years of your retirement, you might reduce it by, say, 3% per year. And you can kind of run that through, and even at the age of 96, you're still spending $32,000 per year, which, I mean, just for reference, that's still $630 per year. I'm assuming that you've got a property which isn't included in this opening balance. And then you can also factor in other things. So, for example, the first few years of retirement might involve a bit of extra travel or some renovations or some car improvements, and perhaps in the first year you want to increase it, spend $20,000 more than you normally would. Third year, $10,000, $15,000. Third year, $10,000, and maybe the same for the next 3 years. So you're spending more in that first 5 years of retirement than you will or expect to spend over the rest of your retirement or decumulation process. Another thing that you can look at when you're going through this decumulation process on your own is you can actually see the impact of investment returns and how that might actually impact your long-term trajectory. As I've spoken about on the blog a few times, we often think of investment risk in terms of short-term volatility or the ups and downs of the share market over a narrow period of time. But there is another risk, which is investing too conservatively and ending up in a much worse position than you might otherwise have been if you'd invested a little bit more aggressively in an appropriate manner for you. So here I've assumed a return of 3%. That may or may not be optimistic, and like I said, the fact that it's constant is a big assumption, because I think as time goes on you probably will invest more conservatively and the returns might decrease. But this is an assumption that most retirement calculators make. But what you can see is that if I reduce, say, a 3% real return down to 1%, so it's only a 2% difference, the chart changes quite substantially. And I mean, if we just make it, if I keep expenditure constant, because I think it will probably just make everything a lot more straightforward. What you can see here is we pretty much run out of money before the age of 91. If we change it to 2%, we get to 94, so that's another 3 years of being able to support the exact same lifestyle. If we get to 3%, we've still got plenty of money by the age of 97 to support you for several more years. So I find this a really useful exercise when I run this with clients to just illustrate that it is important to invest appropriately, and although there are short-term risks in terms of investing, putting all the money in your mattress or term deposits or bonds might ostensibly be less risky and provide you with more certainty about what your expenditure will be, what your returns will be. It's quite possible and likely that you'll end up being able to support yourself for a much shorter period of time, or support a lower quality of life, or even leave less in your estate for other people and causes that you care about. And it's not the only thing that this is not the only model that I do with my clients. I do a few other kind of forecasts in terms of trying to project into the future, including methodologies like historical back testing and Monte Carlo testing, just to see if the results in this simple sort of model, as well as those other approaches using different data sets and methodologies, kind of converge and tell the same story. And everyone's different. Everyone's story is different. Everyone's expectations and values and priorities and cash flow needs and the lifestyle that they want. Everyone's different. Everyone has a bit of a different idea about what they want to do with their accommodation situation, whether and to what extent they want to spend, what sort of buffer they need, what sort of longevity they want to plan for, and what I find is that running through this exercise by doing this kind of more tailored forecast, then you can, with a lot of the online calculators, can provide you a bit more insight in relation to the trade-offs and decisions, and just provides another layer of context and perspective to the financial decisions that you make. So that's what decumulation looks like. And you certainly don't need to decumulate. You can always try and accumulate over the course of your retirement by continuing to increase. Or you could live off the interest, effectively keeping your capital exactly the same over your retirement, 47,000 being the investment returns plus the New Zealand super you receive. And that's terrific. Your children or any causes you care about will love you, because you'll leave a fairly substantial estate behind when you pass away, and they'll be able to travel first class on their many international trips. But that may not be what you want. And so you can generally, if you manage this decumulation process, get away with a substantially higher quality of life than you otherwise would be able to. Like I said, this is just a forecast. What's valuable to do is to check this and do this exercise periodically, and just calibrate how you're going over time, and adjusting your investment plans, your spending, and any major decisions that you make, whether that be right-sizing or helping out family members, in light of seeing your situation in this broader context.